Nvidia has become the first company to hit the $4 trillion valuation, with revenue surging more than sixfold in just 2 years, making it the poster child of the AI boom. But experts are starting to sound the alarm. Sam Altman has cautioned that we may be in an AI bubble, saying that investors are overexcited about the technology. While legendary investor Howard Marks has compared the current AI hype to past bubbles, and Eric Gordon, a professor from the University of Michigan, warned that investors will suffer far more from the AI boom than the dot-com crash. In this video, we'll be exploring whether today's AI boom is truly sustainable, or will the market jibaboom just like it once did 25 years ago. Some of you might remember the dot-com boom of the late 1990s. Back then, the internet was new, and investors thought that it would change everything. In August 1995, Netscape went public, and its stock doubled on the very first day. That IPO, often called the Netscape moment, set off a frenzy. Suddenly, everyone wanted to find the next internet winner. Record amounts of capital started flowing into internet startups. At its peak, nearly 40% of all venture capital funding was going into internet companies. Financial media call it the birth of a new economy, where the old rules of valuation supposedly no longer mattered. And this time is different. Companies were going public without profits, and sometimes even without a real business. All they needed was an idea, a pitch deck, and the magic letters .com. Pets.com became a household name with its sock puppet mascot and a Super Bowl ad. Yet, behind the scenes, it was burning through cash with no path to profitability. Some companies even saw the stock price surge simply by adding .com to their names. One of them was MIS International, which rebranded itself to Cosmos.com and saw its shares jump more than 900%. Even though nothing about the business has changed. Meanwhile, Yahoo, the Google of the 1990s, saw its stock soar from under $5 in 1996 to over $118 in 2000. The Nasdaq itself tripled in just a few short years, as everyone piled into anything with a dot-com story. But when reality sets in, the crash was brutal. From 2000 to 2002, the Nasdaq plunged almost 77%, wiping out trillions in market value. Pets.com vanished, Yahoo lost over 90% of its value, even Amazon, which was just a digital bookstore back then, saw its stock crash more than 90%. Quick pause, if you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Fast forward to today, and the story feels familiar. Back then, Netscape's IPO kicked off the internet frenzy. Today, it is ChatGPT, whose launch in late 2022 sparked the start of the AI boom. ChatGPT wasn't the first AI tool, but it was the first to go mainstream. Within 2 months, it hit 100 million users. This was the fastest adoption ever for a consumer app. People used it to write emails, draft essays, even help with homework. All of a sudden, AI felt real, useful, and the narrative shifted from AI is coming someday to AI is here now. Just like the 1990s, venture capital is pouring in. In the first half of 2025 alone, AI startups raised $165 billion globally, accounting for 53% of all venture capital funding worldwide. There is a level of concentration that we haven't seen since the dot-com era. Not just that, even the branding game looks the same too. Back then, adding .com to your name would send your stock soaring. Today, it is AI. Productivity apps like Notion and Figma added AI features to stay in the spotlight. BuzzFeed announced AI-written articles. Check rebranded its study tool as Checkmate, while entire firms like C3.ai built their identity around this buzzword. Heck, there was even one Microsoft-backed startup that marketed itself as an AI company, but in reality was relying on nearly 700 human engineers to manually code requests. Stock market concentration is another similarity. In 2000, just a handful of tech names drove the Nasdaq higher. Today, it is the Magnificent Seven carrying most of the market's gains. And then, there's the question of substance. In the dot-com era, many companies had a little more than a website and a dream. Today, many AI projects don't look that different. Studies show that 95% of enterprise AI pilots fail to deliver measurable results. So, is this just a repeat of the dot-com bubble? The answer is not quite, because there are a few key differences that make this AI boom more grounded. First, unlike the 1990s, today's AI leaders such as Microsoft, Google, Amazon, Meta, and Nvidia are among the most profitable companies in the world. These companies generate tens of billions of dollars in free cash flow each year, giving them the resources to keep investing heavily into AI without worrying about survival. This makes them far more resilient than the dot-com firms of the 1990s. Besides that, another key difference was that in 2000, internet infrastructure wasn't ready yet. Broadband penetration was low, server costs were high, and most households weren't even online. But today, AI is being deployed on top of a much more mature foundation. There's cloud computing, high-speed internet, and enterprise IT systems. And we can see this clearly in the numbers. Hyperscalers like AWS and Azure are seeing cloud demand grow more than 30% thanks to AI. At the same time, enterprise adoption is accelerating fast. In 2024, McKinsey found that 65% of businesses were already using generative AI, which is nearly double the year before. Not just that, AI is also being treated as a strategic technology in a way the internet never was. Governments are now pouring billions of dollars into subsidies, grants, and defense contracts. In the US, the CHIPS and Science Act allocates $280 billion towards semiconductors and AI R&D. China expects to spend over $56 billion on AI in 2025, and the EU is dedicating €200 billion to its AI strategy. This isn't just about building businesses. It is about national competitiveness and security. In that sense, the AI boom looks less like the dot-com era and more like the space race, where governments are actively competing to be the first. And when you have got this level of government backing, it creates a flaw under the industry. So even if private markets cool down, national strategies meant that AI investment isn't going to go away anytime soon. However, that doesn't mean there's no AI bubble at all. Instead, the reality is that not every part of the AI ecosystem is equally stretched. Morgan Stanley points out that today's AI boom looks less like the dot-com bubble and more like the mobile internet boom, which also play out across three layers: semiconductors, infrastructure, platforms, and software and services. So back in the 2010s, the foundational players in the mobile were the semiconductor companies like Qualcomm and ARM, and the infrastructure platforms like Apple, Google, and Samsung. These firms captured most of the long-term value because they had profitable business models and sat at the heart of the ecosystem. Meanwhile, the application layer was flooded with thousands of apps. A few of them like Instagram, WhatsApp, and Uber went on to become global giants, but the vast majority failed. When we categorize today's AI companies into the same three layers, we will notice something interesting. At the semiconductor layer, we have companies like Nvidia, AMD, and TSMC. These are the essential building blocks of AI, providing the chips that power everything from model training to deployment. Generally, they are financially sound, with strong revenue growth and profitability. When you look at their valuations, they are not overly stretched. Nvidia is actually trading below its intrinsic value. AMD is more or less fairly priced, only TSMC is trading at a slight premium. But overall, this layer feels the most grounded in real fundamentals. Then, there are the infrastructure platforms, companies such as Microsoft, Amazon, and Google. These giants operate the hyperscale cloud services and foundation models that put AI into the hands of businesses and consumers. Many of these companies are already highly profitable and have billions of dollars in free cash flow. While their stocks are trading at a bit of premium, that premium is backed up by their earnings power. Finally, we get to the software and services layer. This is where you'll find companies like Meta, Palantir, CrowdStrike, Tesla, and Figma, all raising to brand themselves as AI leaders. But this is also where valuations look extreme. Palantir is trading at about 4 times its intrinsic value, CrowdStrike almost 3 times, and Tesla is around 4 times as well. Meanwhile, Figma is still loss-making. This is the layer where the bubble is forming. Just like in the early days of the mobile internet, when the hype around apps far outpaced their actual impact. Today, many AI software companies are priced for perfection. While these firms will likely stick around, many of their current valuations assume explosive growth that may never fully materialize. So, if parts of AI are looking bubbly, what does that mean for us investors? The biggest risk is getting swept out in the excitement and FOMO at any price. That's exactly what happened during the dot-com era, where people poured into stocks with no regard for valuation. When the hype faded, many saw their portfolios collapse. The same thing could happen today, especially in the software and services layer, where expectations are sky high. Instead, a better approach is to wait patiently. Strong companies will still be around years from now, and history shows that stretched valuations eventually come back down to earth. Waiting for more reasonable entry points can make a huge difference to your long-term returns. However, it doesn't hurt to dollar cost average in. If you really want to, you could gradually buy in over time instead of betting big all at once. This can help to smooth out the ups and downs while reducing the risk of buying right at the top. And of course, it goes without saying that AI shouldn't be your only bet. It's important to diversify across different sectors and even geographies to ensure that your portfolio can weather a pullback in AI. AI may be transformative, but you need to ensure that no single team dominates your entire strategy. To put it simply, the smartest move isn't to avoid AI altogether, but to stay disciplined. Buy quality, be patient on valuations, and don't let FOMO dictate your decisions. Anyway, that's all for this video. Hope you found this useful. Like, share, and subscribe as I'll be posting new videos every week.